we saw something very surprising come out. This is actually the largest miscalculation in history for US payrolls. They're nearly off a million jobs. This is the third revision, as I understand. I'm going to show you what just came out, why this could change the market significantly with what the market thinks is going to happen with the Fed moving forward. I'm also going to play you the CNBC clip where they walk through it because they have a lot of data here. If you don't mind, hit subscribe so you can see future videos just like this one. Also, if you want to trade crypto, check out BYDeFi. They have a deposit bonus right now. We constantly run different trading bonuses too. So you not only get this first deposit bonus, but as time goes on, you can also get more and more by just trading regularly on the platform. We're about to give away $30,000 from the recent 1-month trading competition. And right now, I do think now is an awesome time to start trading crypto, especially with the Fed gearing up to possibly cut rates a significant amount and over and over and over, meaning more and more people will want to move money from risk-off assets like treasury bonds or treasury notes and savings accounts, money markets, over to risk-on assets like Bitcoin. So check this out now. Now is a great time to start. All right, last week we saw all job gains were part-time. Basically, full-time jobs were negative 357,000 and part-time jobs were plus 597,000. So a lot of full-time workers being fired and having to pick up part-time jobs that may be paid a lot less. Today, the U.S. payrolls were revised by 911,000 jobs, the largest cut in history. I believe this is the third revision. Let me play this for you and see what CNBC has to say about it.
Not getting this.
By the way, they do talk about why this was off so much, what has to change in the future, what this means for the Fed, etc.
Payrolls revision. Let's go to Steve Leisman, who's been looking into that. Steve, what do you see?
I see the biggest revision we've had. I'd go back 25 years here. This may be the biggest revision ever, Sarah. We minus 911,000 payroll growth from April of 2024 through March of 2025 is 911,000 less than previously reported. What has happened now to the month over month or the monthly growth rate has gone from what we thought was 147,000 a month to now just 70,000 a month. So
So let's just pause it for a second. This is ending in March of this year. It was for the year before. Basically, there are half as many new jobs as predicted. Or not even as predicted, as calculated.
7 million jobs is now 847,000 jobs created over that period. So over that time period, payrolls were quite a bit weaker. Remember, this is the period ending 5 months ago. This is the annual benchmark revisions that's done every year. This is a preliminary number. Over time, it tends to actually be revised a little bit higher. The revision to the revision ends up being a little bit higher, but right now it's suggesting much weaker payroll growth. I will point out that this is definitely toward the high side of what I've seen from Wall Street analysts. And now you have to plug in you have to start thinking about what does this say about today? In other words, this data is 5 months old. We won't know until the final revisions in February which month each of the weakness belongs to, but we do know a bit about which industries it belongs to.
Okay, I'll keep on playing in a second, but look at this. The recent benchmark revisions have been negative, and more negative. Like almost, again, like 50% off in terms of what they thought we had for new jobs. This means that the Fed's working with very outdated numbers, or has been. Maybe they heard about this before we did. Maybe they got alerted to it, and that's when they decided to change their stance on cutting rates. Maybe this was one of the deciding factors. But this shows that the jobs market is even weaker than we thought last week, which means that they are forced to cut even faster, or they are forced to cut even if they were kind of on the fence before.
And we have a chart here, 880,000 from the private sector. The biggest revision came from trade, transportation, and utilities of 226,000, 126,000 off in retail. Leisure and hospitality down 176,000. Professional business services down 158,000. So widespread I don't see it here. Not a lot in private education and health services, which was the big, you can see the recent revisions there. The second biggest revision that I have, Sarah, in my records is 2009 in the wake of the great financial crisis. And what had happened in that situation was some of the modeling was wrong. Some of the birth death of businesses was wrong. This may be the case right now. We might have come into this year with much more weakness than we thought we had in the job market. It was okay. It seemed to be like the unemployment rate remained relatively stable. So whatever we were doing was okay to keep the unemployment rate, a separate survey, relatively low, but we were not creating as many jobs as we thought. And I know that some Fed officials, Chris Waller among them, think this is part of a broader story of weakness in the job market that should cause the Federal Reserve to cut. And we'll see what happens now to I don't know if we're able to get you right away an update on the Fed funds futures, but certainly the market was primed for 325 basis point cuts this year. And we'll see if I could take a look right now to see if there's any more play on a 50. And there isn't, and there probably shouldn't be. I don't know that this will motivate Fed officials to do more, but it will motivate them to do something.
Right. Those were my two takeaways, Steve. Number one, this sort of ratifies the idea that they should cut next week and that job growth has stalled and has slowed and looks even worse than they originally expected. And the last few months have been weaker. And then the second is my question about the process. So how were we almost 1 million jobs short in terms of, there have been questions lately about how this process, this data, the president raised it, he fired the BLS chief. Does this feed into those concerns about how the data was so off?
I think it should, and I'll tell you why, Sarah, because when I look at the history of these as a percentage of payrolls, actually they do a pretty good job when you look at the revisions as a percent, 0.1, 0.2, it's averaged about 0.3. This is 0.6. This is double the average. So, and let me just see if I can find out the last couple of years. Yes, and it was 0.4 in 2024. So the last couple of years have been quite a bit above average in terms of the amount of revision. What's happening here is we're getting jobless claim insurance data from the states. I don't know if the problem is at the state level or if it's at the federal level. Whatever it is, there's something not going quite as well as it used to go in terms of the ability of the BLS to gather monthly data. Here's the process, Sarah, which I'm sure you know, but maybe not every viewer knows, which is that we get it at the next month, the 15th of the month or the 12th of the month, we get it once. Then we revise it again. Then we revise it a third time until the annual benchmarks come along. We revise it on a preliminary basis and revise it again. We keep counting it and keep counting it, but it looks like the counting, as was evidenced in that big June revision on the preliminary stuff, is not as good as it was, and it's not as good as it was even on a annual basis. So we seem to be having a problem here, and something needs to change. I've often thought about the idea of, can we do better, getting better data from the states on a more consistent basis.
So is the market collapsing or spiking on this news? No. Stock market just slightly green. Bitcoin just down a little bit on the day. There's some manipulation, some liquidations, that kind of thing. It's just chopping around its range. So it's not like this is majorly concerning to the market right now, but I think it's because there's a balancing act. Yes, there are worse job numbers, but also this means that the Fed's more likely to decrease rates and continue to decrease rates, which brings more money to risk on assets, which also allows for businesses to hire more aggressively, especially maybe businesses that aren't going to take advantage of AI quite as much, like Amazon, Facebook, or Meta, Google, but like companies that maybe need loans to be able to expand, as opposed to these companies which are just so cash rich that they don't really need that. But your mom and pop to hire, some kind of construction crew needs a lower interest rate, which can be affected by the long end of the curve, which can be affected if the bond market thinks that the Fed's going to continue to cut rates, right? So that's a mixture of the labor market and inflation. Of course, we have inflation data coming out the next 2 days, CPI and PPI. PPI being a leading indicator, so be on the lookout for that. Thank you so much. I appreciate it. Let me know your thoughts. Check out the links to BYDeFi underneath the video and BTCC, BitUnex, Weeks, Blowfin. I'll see you in the next one.